I think it's important to think about what the incentives are. As Charlie Munger says, show me the incentive and I'll show you the outcome. I posted it into our group chat. Credit Suisse sent all their private banking customers an offer. They are now offering 6.5% for a 3-month T-bill. 6.5%. And if you go back to what we talked about before, when the risk-free rate is somewhere north of 5 or 5.5%, and banks are willing to give you 6.5% in the short term, you have to generate more than 3 times that to make an investment make sense when you're investing in the long term. So if 3-month money is going to pay you 6.5 or 7, if you're going to invest for 10, 15 years, which is what you need to do typically for a startup, you need to get 20 to 25%. So there's going to be a lot of pressure for venture investors to put the money to work, because otherwise their LPs, their limited partners, the people that give them the money, will have this attitude that goes somewhere along the following lines. Okay, I've committed to you. Why aren't you investing? Because otherwise I can get paid 6.5% on the front end. And so this is becoming very problematic. What am I paying you for? What am I paying you 2% a year in management fee for? So I think what happens, unfortunately, is the opposite of what Doug says. I think good investors will try to follow Doug's feedback and advice. And the ones that have a track record of distributions of DPI can do more of it than not. But I think most people will be under pressure to deploy the capital. And so the 500 odd companies, Jason, you mentioned, will get a lot of it and it'll get torched because most of them probably won't amount to much of anything in the short term. You will create way too much correlation and you will have zero time diversity, which, as we've learned, is a recipe for terrible returns.
Time diversity being, hey, you deployed all this Web3 capital, crypto, whatever, in this very short period of time. You overpaid. You
Lit it on fire.
Lit it on fire. Brad, when you hear Chamath talk about this 6.5%, and then you look at private markets, you invest across the life cycle of companies. Obviously, you're in some private companies we all know very well. Famously, Snowflake, I think your biggest win ever. Correct me if I'm wrong, in terms of a private. How do you look at this when you're a steward of capital, public markets, private markets, and then just YOLO, just put it into, some T-bills or bonds or whatever?
I mean, first, let's just frame, right, the chart that you showed. I think it said, ex OpenAI, I don't know, something like 10 or $11 billion has been invested into some 500 AI companies. I mean, I happen to agree with Doug that this is a platform shift on the same magnitude as the internet or mobile itself. In fact, it may be bigger than both of those. But, when I look at 10 or $11 billion, let's put it in context. Meta's going to spend $20 billion in 1 year alone on AR/VR. And this is on an entire platform. So I don't know. I think whenever you have something as tectonic as mobile or internet, it deserves a lot of investment. And yes, it's going to be messy. And yes, Chamath's right. The cost of capital, frankly, is limiting the amount of money going into these businesses already. So we see a lot of dry powder sitting on the sideline that's chasing new ideas. I think one way to frame it as well is like, think about in 2000. We all knew that the internet was going to be big. We may have been lucky enough to conclude that search was going to be big. But if you invested in Yahoo or InfoSeek or AOL or Excite,
Lycos,
you tore all that money went to zero, right? So now think about just these large language models, right? The foundation models which are driving and enabling all of it, OpenAI. You've got OpenAI, you got Anthropic, you got Cohere, you got Character, you got Stability, you've got Lambda. It is almost impossible to know with any certainty, much like it was with the search engines in 99, 2000, who's going to emerge, where the value capture is going to be. It may all end up with Microsoft and Google. I mean, this may end up looking like iOS and Android at the foundation model level. And so, I think as investors, for example, on the foundation model side, I think it's very difficult to choose just one, particularly when the largest one is frankly captive and a proxy to Microsoft, and they're capping your upside return. So those are difficult investment decisions. That doesn't detract from the fact that I think it is as big as Doug suggests. And I do think there are going to be applications and tooling layer to come out of this that's going to produce really big winners. I would say that we are spending an extraordinary amount of time in the space. We haven't made a lot of investments. I think you have to study, you have to get deep. I mean, Chamath certainly and I have been investing in this space for at least a decade, maybe 15 years. But don't underestimate that the transformer model really did change the game here. And we're now producing impacts much larger.
Sachs, last week you said Web3 and crypto didn't kind of stick with you. You didn't see the use cases. And you, in the first inning here, or first at bat, you rattled off 3 or 4 really compelling use cases, from summaries to the assistant guide on your side concept. Is this akin, in your mind, because Brad just said it could be bigger than mobile, internet, mobile, AI revolution? If you were to look at those 3, do you think it's bigger than actually mobile? And then we'll get into return profiles of 6.5% on cash versus what our VC is going to be able to do in this kind of market.
Yeah, I mean, so I agree with Brad and Doug that this is the next big platform shift, whether it's as big as mobile or it's more like social or cloud. I mean, those have been the big platform shifts over the last decade or two. And I think this is definitely on par with those. I think Brad's right. We don't know where the value capture is going to be. Maybe it just all ends up accreting to the big companies who can make massive investments in this space. One difference between the internet ecosystem today and 20 years ago is you do have these giant companies who are not totally incompetent, right? I mean, they do have lots of talented engineers. And, like 20 years ago, you'd have the big companies would just sit on their hands in the face of a platform shift, and they'd just be sitting ducks who get disrupted. That's not going to happen today. That being said, I do think that any new platform shifts creates opportunities for startups. And it may not be efficient the way that these opportunities get pursued, in the sense that, yeah, Doug's right that there's going to be a lot of spray and pray. But I think that it is kind of efficient for the ecosystem as a whole, right? Because like any smart engineer with a half decent idea ends up getting funded. And out of all of that, you get kind of a Precambrian explosion where, the ecosystem evolves a lot of different types of businesses. Most of them don't work. They get wiped out. They go extinct. But there'll be some good things that get funded. So we're more like, I think, Doug, in how we see it. We don't want to spray and pray. We want to be very selective. We want to put more money behind fewer opportunities that we think are better. And Doug Leone, I think he generally gives good advice of the tough love variety. And this is of a piece with that. And so I agree with him. That being said, there is a certain value to the ecosystem and having all these seed funds to spray and pray, right? Because it just it plants a lot of flowers, and then you see what blooms.